When we think about people who put their money into the stock market, we usually lump everyone into the same category. But in reality, there are two very distinct paths you can take. You're either an investor or a trader. Today, we're going to do an apples-to-apples comparison to help you figure out which one fits your personality and your financial goals best. First, let's look at the stereotypes. When people think of a trader, they often imagine the frenetic energy of a trading pit, sleeves rolled up, yelling orders, and watching every tick of the clock. On the flip side, the investor is often seen as the white-haired guru, someone who knows the inner workings of a company's balance sheet and isn't bothered by daily news. While these are extremes, they represent a fundamental split in how people approach the market. To understand these differences fairly, we need to look at three main pillars: time frame, activity level, and risk management. While both groups use the same stock market, the way they navigate these three areas is completely different. Let's start with the traders. For a trader, the market is a place to seek quick, short-term gains. Their entire goal is to master the cycle of getting in and getting out with maximum profit so they can do it all over again. Because of this, their activity is driven by technical analysis. They spend their time analyzing price charts and signals rather than the company's CEO or products. Because traders move so fast, risk management is mechanical. They use stop orders, which are preset exit points to cut losses, and price targets to lock in gains. For a trader, risk is all about the probability of success on a specific trade. If the chart says a trade isn't working, they get out immediately without looking back. Now let's look at the investors. Their time frame is considerably longer. We're talking years or even decades. Investors aren't just looking for the stock price to go up, they also want to generate income through dividends. In fact, a true investor may buy a great stock with no intention of ever selling it, even when the market gets bumpy. Instead of looking at charts, investors use fundamental analysis. They dive into quarterly earnings reports, balance sheets, and financial statements to judge a company's health. For them, risk management isn't about setting a stop loss, it's about picking the right business in the first place. If the price drops but the company is still healthy, an investor usually believes it will recover over the long haul. Here's the breakdown. Traders work in days or weeks. Investors work in years. Traders follow the charts, investors follow the business. While the trader wants a quick profit from a price swing, the investor wants long-term appreciation and a steady stream of dividends. It's two different games played on the same field. So, which one are you? You might be a trader if you love the thrill of the move and have no real interest in what a company actually does, as long as the stock price is volatile. But you might be an investor if you have a strong conviction in a company's long-term growth and find yourself uncomfortable jumping in and out of the market based on daily news. In the end, the answer doesn't have to be one or the other. Most successful people find that they are a bit of both. You might keep 90% of your wealth in long-term investments where you act like a patient investor, while keeping a small 10% tactical fund for active trading. Ultimately, the best path is the one that lets you sleep at night while your money works for you. Thanks for watching, and I'll see you in the next video.